All right. Hopefully you're here for Tax Tuesdays. If that's the case, this is Tax Tuesday where we're bringing tax knowledge to the masses. My name is Toby Mathis,
Elliot Thomas.
and we're going to be your hosts for the next foreseeable future
Yep.
until we get through all these. Usually about an hour. Usually. Used to be 2 hours. But let's let everybody flow in. How many people we already got on? Let's see. Oh, yeah, they're flowing in. All right. So we will start getting going. If you're alive and kicking, give me a thumbs up. That's what we like to see who's in the room. Give me a thumbs up if you're able to use an emoji. Look at all that. There's a bunch of thumbs. All right, so everybody's loading up. All right. The simple rules. If you have comments, put them into chat. Like Elliot looks really good today. You can put that in there. If you have questions, put it in the Q&A. Like, I've had a house, I've lived in it for the last 5 years, I rented it for the last year. Can I still do a 121 sale exclusion? And which case we have a bunch of folks on. I'm looking at it right now. Matthew, Patty, Arash, Dutch, Jared, Jeff, Rachel, Troy. You got a bunch of tax attorneys and accountants and others there to answer your questions. And then we're just going to send you a bill. Joking, we're not going to send you a bill. We don't charge, just don't abuse it, right? And then if you ask a million questions where it's getting really technical about your return, probably invite you to become a client. And that's it. It's supposed to be a little bit of fun. So we usually do have a good time. If this is your first Tax Tuesday, give me a smiley face or something. Give me some indication that this is your first time. We want to know who the first time there.
Smile.
Crying, getting cry emojis.
Scared.
Scared. They're like, oh crap, what did I just get into? You got into the tax world. We're gonna have some fun.
Is the IRS censoring this?
Yeah. A bunch of agents are on. They should be. They need to learn some of this stuff so they don't make jack decisions.
That was him.
Yeah. Hey, call it as I see it. All right. Let's dive in. These are the questions we're going to go over today. We're going to go over in order, so don't worry, we're not going to answer them right now. We're just letting you know what the questions are so you can decide whether it's worth your while to sit here and deal with this. Yes. All right. What is the best way to avoid estate tax? And Elliot picked these. Right? Where's this? All right. I'm a nurse. I'm interested in starting an assisted care business in my home. Any recommendations to use for taxes or startup strategies? These are like open-ended questions.
Yeah, they are.
My wife has a single member LLC engineering firm and it's taxed as an S corp. I plan to open my own business. Congratulations. Would I be able to open my own single member LLC taxed as an S corp? My CPA advised me to run my business through hers so that only one 1120S is filed. But I can't see myself doing that, probably because you're smart, right? I want to completely separate my business from hers. What do you think? We'll get into that one. You're picking like.
I know.
All right. Can I use my vacation home as a short-term rental to tax write-off? If so, how do we do that? That's a pretty good one. All right. So we're going to. Yeah. We hear a lot about 7 average days, but there is a lot of confusion behind those 7 days. Some say it has to be 7. Some say it doesn't have to. Well, the laws, we'll go over what the law says. So if I have, let's say, 2 bookings of 2 and 12 days, to me, that's 7. And if I have 4 bookings of 24, 3 and 7, that's an average of 7 ? So yeah, we'll dive into that. It's not horrifically difficult. And it's actually it's very simple. I've realized capital gain from installment sale in 2023. Congratulations. I've not received capital up to my basis yet. I will have a chunk every year up to the next 5 years. Can I still invest in a qualified opportunity zone? I hope you know these.
Yep.
Thank God. I'm just kidding.
It'll be a short out.
Somebody's got to know the answers because I'm gonna have to use a lifeline. Do they have lifelines? I need a lifeline. I would like some focus on 1099 related options. Would like some focus. I'm a truck driver and I feel I'm paying very high taxes. Not the first time I've heard that from a
Right.
truck driver, right?
Yeah.
I sold our investment property in 2023, which was previously our residence for 10 years. When we started renting our property about 5 years ago, our CPA did not advise us on updating the cost basis. So I'm trying to figure out whether they own this thing for 15 years.
Mhm.
We'll get into that. We have done many upgrades to the house during our 10-year stay. So this year, when we file our taxes and report the sale, we'll be using the initial cost basis for the house. My question is there any way to deduct expenses we had when it was our residence? Okay, I think I'm getting it. Good question. Good question. We'll get into it. Makes the wheels start to turn, and they're rusted. They got stuff in them, gunk. Right. I see different ads from others saying there are options other than a 1031 exchange to defer taxes. Looking for any viable options, please. Being a senior over 70, I really enjoy the videos I watch on YouTube, as it's never too late to learn and try to understand real estate investing and taxes. But even if I do pick up some of the things, I still would need experts to do the job for me. What would it cost for Anderson's group to follow my future investments? I want to do this for my daughter, who is now in her second year of college. Good questions, and we'll get into that. We're not financial planners, so that side of it's going to be, but from a tax and compliance standpoint, we could probably help. Speaking of YouTube, hey, there's YouTube. A lot of fun. YouTube is, especially recently. It's been a lot of fun doing a lot of these rules and stuff. All right, so if you feel like it, want to join our YouTube channel, there's two. I have one and Clint has one, and they're absolutely free. We also stream, I believe we stream Tax Tuesday on it. Hey, Matthew, do we stream it on YouTube?
Yeah.
All right, we do apparently. I have it on good authority that we stream on YouTube. So you guys are probably chatting on YouTube. And then my partner Clint, who I've been partners with since 1999, probably 98 actually, but we actually formed Anderson in 99. A long time. He does a great job on his channel. You should join his channel too. And I think there's a link that gets you to one of them. I have no idea, but if you Patty, just put those in the chat. Feel free to join up. We don't hound you. It just, you get notified if you click that little bell. Notifies you when a new video goes up. And they're always fun. A lot of tax topics on mine, a lot of asset protection on Clint's. Speaking of tax and asset protection, we do teach workshops. At this point, it's like every week. There's two live ones coming up, which are a lot of fun, where we actually get together. It's a bunch of investors. It's usually 400 or 500 people. September and December, we have them coming up. September in San Diego, September 26th to 28th. We'll be there, and they're very inexpensive tickets. And then December is in Vegas. Come to both if you feel like it. And then if you just want to learn the basics of asset protection, we teach the virtual workshops. We have folks that have been going, that go a couple times a year just to get brushed up and make sure they're doing everything right. Clint does a fantastic job teaching that one. I teach him a lot of times with him. Amanda's been teaching, and Brent Nagy, one of our longtime clients, who's an investor, does a very good job of teaching it. He came out of the Rich Dad organization, worked with Robert Kiyosaki, and has done really well in his real estate, but he's really good at teaching. So we love having him come on from a non-legal standpoint, like he comes in and uses plain language. All right, let's dive into the questions. You guys ready? All right. What is the best way to avoid estate tax?
Okay, I think, well, the obvious answer is, of course, you don't die, but given. Yeah, I figured. But
Right.
ways to get it out of our estate before is kind of what we're looking at here. Maybe setting up a nonprofit, very popular option with a lot of our clients. And we have ways working with our team there, Kareem and the rest of the staff there. They're exceedingly good at what they do, working with these nonprofits. There are options such as what we call irrevocable trusts. Basically, it is as the word sounds. You put it in the trust, it's irrevocable, it doesn't change. That might get it out of your estate to where you could have the beneficiary be some of your offspring, et cetera.
Kareem agrees with you. Apparently he's watching. Believe it or not, at the head of the nonprofit
He's actually listening in. Well,
He says, hey, that's a good idea. All right. So the estate tax, they tax you during your life. Like we make $1, you're going to get taxed. If you're a business, then you make $1, you spend it, and then you're taxed on what's left. But whatever's in your estate, whatever the value of your estate is, if it's over a certain threshold, you're going to get hit with an estate tax in the United States. And in your particular state, you may get one. Like there's states, I think Oregon's $1 million exclusion, right? Anything above that, you're going to get hit with the estate tax. So we're just going to talk federal for now. It's insanely high. It's over $13 million per spouse. So you don't have to worry about the estate tax unless you are over 26 million. And that's the fair market value of your assets. You actually get them appraised when somebody passes away. That's supposed to go back down. It's supposed to sunset in 2025. And we're going to be somewhere in the $5 million range per spouse. I think portability comes along, which means that you can use it each spouse. If that goes away, there's a drafting technique using a living trust that enables us to double it up. We never rely on just the way the law is written now. We always want to be flexible. So our estate documents already have the AB trust components drafted into them. But you want to make sure that if you're married, that you're using up the estate exclusion for both. There's a lot of practitioners in the next year. You're going to see this stuff like crazy doing spousal lifetime access trust, these slats and stuff. There's a lot of drawbacks to them. We're not huge proponents of them here. But if you have a large estate and you want to use up your exclusion, I got 13, I don't know the total amount is this year, but it's big. You want to use up your $13 million. One spouse could give to their other spouse that 13 million. You can't go back and do it the reverse way because you have a reciprocal trust doctrine that would invalidate that, even though most practitioners ignore that and just do it anyway. But you want to make sure that you're just being cognizant of it. The best way to avoid it is what Elliot said. Sometimes it's giving it to an organization and letting your kids serve on the board of a public charity or a private foundation. Sometimes you set up a memorial fund or things like that. We do have clients that have done that successfully. It gets it out of your estate. We're not worried about the tax deduction at that point. We're only worried that it's not included in your taxable estate when you give it to charity. The other thing is transferring it during your lifetime and getting it out of your estate to something else that might be an irrevocable trust. They can be used for that purpose. Although again, we're not huge on it. Minimizing the tax burden with your estate by using entities, you get what's called a discount for lack of marketability so that the appraisals are lower. And then what an insurance person would tell you is buy a lot of insurance to pay for the tax. And then the estate tax for US citizens is one thing. If you are if you're here and if you're a foreigner and you have assets in the United States, the exclusion is only 60,000. So you got to be pretty careful that you don't, you buy a $500,000 duplex and you didn't think about it, and then you pass away and your estate, all of a sudden the feds are saying, hey, that $440,000 of gain, or no, actually be the 5 million. They don't even care about that. It's not even the gain. It's the 500,000. They're going to give you a $60,000 exclusion and tax the heck out of you. I think you're going to be in the highest bracket at that point. It's 40% right now, although there's proposals to get it up to 65%. But you're looking at 40% tax for 440,000. So like over $160,000 tax on that transaction. It's not small. It sneaks up and blindsides people. So you want to make sure that you're addressing it. And the best advice I can give you is talk to somebody who understands the estate tax and apply it to your situation and go through a couple scenarios. What if this? What if this? And then say, here's the way to add some flexibility into your estate plan so that you don't inadvertently make a mistake. And our trusts, we make it very flexible for the trustee to make decisions based on the law that is in existence at that time. So, somebody was, I think it was Jeff earlier was joking about Steinbrenner internally. We were like, how do you avoid the estate tax? Die when it doesn't exist. One year Steinbrenner passed away, $1 billion plus, no estate tax that year. Right. But you want to make sure that whatever the situation is, that you've empowered somebody to take action that's in the best interest of your estate. So that if you're not able to, because you're incapacitated, that you have empowered somebody else to do it, or when you pass, that if there are options, that they're able to take the option that's best for you. And that's by using a living trust or or an estate plan where you can actually give somebody those powers. Even a financial power of attorney will oftentimes be very, very helpful.
So it wasn't that bad of a question, was it?
It was open. It's like, I knew you were going to say, just don't die, right?
I think
You could
everyone's
say
going,
this, entities don't die, right?
right,
So
yeah.
your living trust carries on, your LLCs carry on, your corporations carry on. If you have a nonprofit, nobody even owns it. You transfer control to somebody else. You can give veto rights to them. So you really can do it. You get there. Green card or citizen. Somebody says foreigner, non-citizen. Uh, I think you're okay. Is it if you have a green card, do you get the estate tax exclusion?
I always have to go back and double check that. My understanding is that usually green card, I'm not aware of any situation where you're not treated like a regular US citizen.
Yeah, if you're green card holder, I believe that you're getting that, but we want to check on that. If you're a non-US citizen and you have assets here, then it's just make sure you're talking to your tax person and asking them, hey, what happens if I pass away next week? What's going to happen? And just have them go through the scenario with you. All right. I'm a nurse. I'm interested in starting an assisted care business in my home. Any recommendations to use for taxes or startup strategies?
So I really like this one. The reason I picked it is because in a couple of these, it is going to go a little bit outside of our realm of taxes, and I know that's our primary focus. But here, often people would just set up the building, the rental that they're the assisted living building, put it in a business, maybe an S corp or something like that. But we want to take care for a little bit of asset protection here. So we're going to take the building itself, put it in its own box, its own LLC, and then you're going to have a separate billing for the operations. And I think right there, it's where tax planning and asset protection are just walking perfectly hand in hand. We can do things with the taxes on the billing itself, and you can run your operations over here in a separate.
But she's talking about it in her home.
Oh, within my home. Oh, excuse me. There, well, we'll still probably want to put some asset protection around that. Yeah, you'll definitely want to put the operations probably into maybe an LLC of some sort, disregard or something like that. I think it could still be disregarded there. Definitely you want that asset protection still, but we're going to look for, just the regular deductions, such as the use of that space all of a sudden becomes business use. You'll be able to add up that square footage and so on and so forth, and be able to take a lot of deductions against the cost of running that house, just your regular expenses, plus of course, all the business expenses.
I would, all right. So I would dissect this a little bit farther. So she's starting an assisted care business. So that's a trade or business in your home. So the question is, are you meeting people in your home? Are you bringing them in? Because if you are, that's a whole other liability kettle of fish, right? There's a lot of issues with having people in your house as your place of business. You'd want to make sure that you have good insurance and umbrella policy, and you'd want to isolate that activity into its own entity, including the real estate you'd want to isolate into its own entity. And I know it sounds weird because you're saying it's my house. Yeah, you want to make sure that whatever happens on that house, because if you invite people in an assisted care and something catastrophic occurs, you don't want them to take everything else that you own. You want to limit it to the insurance and the equity in that business. That's it. The actual business itself, it always depends on what you're going to do with it. So let's assume that you're going to build it up and sell it. You might be a C corp proper because you want to do the 1202 capital gain exclusion. Like you say, hey, I'm going to build this up and sell it in 3, 4, 5, 6 years, whatever it is. And I know it's going to go for a multiple and I'm good at this. That's not everybody, right? That's a very small percentage. The other route, which is probably the more likely, is, hey, I'm going to run it. I just want to have an income source. I'm probably setting you up as an LLC taxed as an S corp or as an S corp as a starting point. I think most practitioners are going to start there. Is that what you would do?
Yeah.
And the reason being is because you're looking at it saying, hey, I want to have an accountable plan where the business can reimburse you for a lot of things that you're using the home for. The square footage, for example, you're going to look at everything that's a cost in that house, all your utilities, if you have a mortgage payment, the interest you pay, property taxes, insurance, everything, and you're going to figure out how much, what percentage is the business using of that home. And you could use room methodology, you can use net square footage. There's a lot of options you have when you actually have an S or C corp in the mix that you don't have when you're just a sole proprietor. So we do that, and now the company can reimburse you tax-free a chunk of money. Plus, it could do 280A, which is the Augusta rule, which we'll use for having our corporate meetings. Plus, you could do everything from your cell phone to all your equipment. All of these things become 100% deductible to the business, and you don't have to figure out the personal usage of them. As long as it's benefiting the business, it can write it off. And what that does is it does two things. A, it's going to save you a bunch of money in taxes. Let's just say, hopefully you have a great year and you're making, $100,000 a year net or something. It's going to save you about $10,000 in taxes just to avoid the employment taxes if we made an S election on an LLC or on an S corp proper. So either one of those is really going to be of benefit, depending on whether you're married and you have other income sources, things like that. I'm not seeing anything in the chat, so I don't know if this person is there. I don't think so, but or I'd ask some more questions. But if you're married with a high income earning spouse, then I might say a C corp might be more interesting. And then the other one is, what are your medical expenses like? Because a C corp may be more interesting there too. But I'd be breaking it down into two categories. I'd be looking at the operating business and then where it's taking place. And if you are meeting people in your house, there's one strategy. If you are just using your house as an office and you're not meeting anybody there, there's no liability, then that's a different strategy. Then I wouldn't be so worried about structuring the house.
Yep. That's it.
So much fun. All right. Hopefully you guys got it. Are there any questions on that? I just threw so much at you guys.
First year loss.
All right. If she thinks she might operate at a loss the first year, how about starting as a sole prop, then going S corp when making money? You still get the Nick. You still get the losses when you're an S corp. So I would still probably start off as the S because it gives us the accountable plan, and we'd probably create more loss that way. The other reason I do that is because the audit rate between a sole proprietor and an S corp is the difference of hundreds of percent, if not more than 1,000% higher for the sole proprietor. So the last year I have the access to the data was 2019, where they would break down what the audit rates are for the sole proprietors. They quit publishing it under publication 55. But it used, like, all the years that we can go back and look at it, the audit rate for sole proprietors were usually 400%, 500%, 600% more than anybody else. Like, they're way up there. And when you compare them to an S corp, the last year I have, it was an asterisk for the S corp, meaning that was below 0.5%, and it was 1.6% or 1.4%, excuse me, for 100,000. It was a little bit higher when you made more. But if you were a sole proprietorship making 100 grand, 1.6 versus 0.5%, it wasn't even close, right? So and there's tax benefits. So that's the way my mind thinks, is I don't want to tangle with the IRS. I don't want to mess with them. No matter what, I'm putting an entity around it. So even if you were a sole proprietor, I would make her a I think it's, yeah, no, we went to the next one. Stop that. Whoever it is, if it's a man or a woman, I can't tell. It's just a nurse. Whoever that is, I would use an LLC around their business to isolate the liability, so that if they have evidence, like maybe they unintentionally cause harm to somebody, or maybe somebody else causes harm, but you are treating them too, and you get sued, because lawyers like to sue everybody involved. that you don't risk your personal assets and have a catastrophic failure because something goes wrong in that business. I hope that makes sense. Are there any other questions on that one? Somebody says your comments about risk of having people home, I think needs an entity. 100%.
Yeah.
If there's people coming into your house, I'm putting an entity around it, period. Just seen too many bad situations where you don't even mean to. It's just, but you end up with liability that just, it's just bonkers how they're suing people nowadays. All right. I think this was the next one.
Yep.
My wife has a single member LLC engineering firm and it's taxed as an S corp. See, engineer smart, by the way. Engineers are the #1 category in the United States for millionaires, by the way.
Yeah.
Number 2 was accountants. Number 3 was teachers.
Teachers, yeah.
Yeah. So your engineers they're super smart and they always edit my books after the fact. They always like, hey, you could have said this. They always find the typo that we missed in 20 proofreads. All right. Taxes and S corp. I plan to open my own business. Would I be able to open my own single member LLC taxes and S corp? Yes. My CPA advised me to run my business through hers. No. Horrible idea. Horrible idea, but I can't see myself doing that. Good. Because it's a horrible idea. Your CPA is looking at things from a let's make how many tax returns we file the #1 issue in your life, and let's risk everything else that you've worked so hard to build up and own, and let's just make it a dumpster fire. But you only have to file one return. Jiminy Christmas. I want to completely separate my business from her. What do you think? Sorry.
So I gotta say, I think everybody can understand out there. I picked this because I knew how he'd react.
Not nice. Just like,
Right? So there is no question for absolutely what Toby was already getting at. You know, you can't really improve on that reaction, but you want to separate these businesses because you're going to run into that just jerk, you know, like me, who's going to sue you and find out it's all under one. You get both your businesses under one S corp. I don't care which one. I go to your spouse's or your business. I'm going to take it all. Okay. And so you want to separate those two businesses without any question. And then the last thing you should be worried about is the number of tax returns. In fact, the fact that they are separate tax returns is what's going to save you a lot of that, you know, a lot of pain.
the court literally looks at things and says, how much respect do you show your business?
Mm.
And I used to clerk for a judge, and she would always say, I'll show you the same amount of respect you showed. And so I was like, so, and she would look at it and say, you treated your stuff with disrespect. Why would I respect it? Right? You didn't do any formalities. Why would I honor this? You didn't think enough to even separate it out. You know, she would do things like that. And I always kind of listened. Yeah, fire that CPA. Well, your CPA's looking out for you in a way. They're saying like, hey, I'm going to charge you a lot for an extra return. It's still the same information that's going on there. It shouldn't be that much more, right? It's the same info, whether it goes on this S corp return, the 1120S, or this one. Who cares? And if you really want to get to one return, there's a way to do it. It's called Q subs. You set up a parent and then you have it own the other S corps. But with a engineering firm, that's a license. You should not be doing anything under that business other than engineering. It should be completely separate from everything else that's going on. Even if she had another business that says, hey, I do engineering and I also am an expert witness over here, I would actually isolate those. Right? I don't want something that happens in one of my lines of businesses destroying my other lines of business. These are each little revenue streams. They're armies. You're sending out your little armies to go out there and collect prisoners and bring them back, right? You don't want to have them all mixed up so that one bad occurrence wipes out your entire army. You want to keep them separate so they can go off and do what they're doing and make sure that they understand their directive. So, really, please don't combine those businesses. That's just
And
ill-advised.
just to add to what Toby was going with on the engineering firm, there's some occupations, and engineering might be one, where you can't have another business owner in there other than a licensed professional. So if somehow if it had been decided that you were going to put in as a shareholder or something into this particular S corp, you could unwittingly have just run afoul of all the licensing in that particular state. So,
Which could cause a piercing, which could
yeah,
cause you to have exposure on your personal assets. Just
yeah.
like we've done it long enough, just take a word for a bunch of lawyers that you see just really bad cases all the time. Like we all do. We've all had to deal with them. We've all seen just crappy lawsuits. Don't give them that in, because we would exploit it if we were on the other side. We'd be like, you
Oh,
guys.
absolutely.
So
Without question.
yeah, and it's cheap. I know it
Yeah.
sounds goofy, but you're not saving that much. It's the same amount of work. It's just 2 returns. So they're just charging you for the extra return. I've seen that enough.
Yeah.
Even if it costs you an extra $1,000 a year, it's cheap insurance to keep those puppies separate.
Everybody know what Toby thinks?
Yeah. Toby just.
You're killing me, Smalls.
Mhm. Yeah, don't set me up like that. It's me. All right. Can I use my vacation home as a short-term rental to tax write-off? If so, how do we do that?
Yeah, this is, we kind of ran into this last time too, but this question keeps coming up and up and up, and I get asked this probably far more in the last 3 months than I did in the last 3 years. Whenever you have a vacation home, first of all, my first advice, you don't, it's either vacation or it's business. You don't do both, okay? I know that there are some rules that allow a little bit of that, but I tell clients, look, do as you will, but I'm going to tell you not to. If you run and use that vacation home, you're running as a rental, okay? If you use enough personal use of it, more than the greater of 14 days or 10% of the number of days that was rented out at a fair market rate, then it becomes what we call a personal residence under the code. Even though it's not your primary residence, it's a personal residence. And if we hit that status, now if you, let's say your short-term rental income was $5,000, but your expenses related to that were $7,000, you're going to be limited. You're going to be cut off, truncated at $5,000, the amount of income. You can't create a loss from that business. So I wouldn't recommend, mixing the two, but if you're going to, just be very aware of the greater of 14 days or 10% of fair market rental days.
I'm not as harsh as you. I'm looking
Yeah.
at it like if you could make some extra money on your vacation home and you're willing to do it, you can write off a chunk of it. It depends on how many days you're using it as a vacation home. So let's just say you're using it 40 days and you rent it for 100. So what do we have? We have 10% of the days. You're well above 10% of the days. So you rented it for 100. If you went over 10 days or 14 days, whichever is greater, so it'd be 14 days, then it's a personal residence. And all that means is that you have to figure out what period of time you used it as a residence versus as a rental, and you get to write off that portion. So in this particular case, 40 days and 100, you'd put that ratio. So out of 140 days, I don't know what that number is, 1 point, whatever it is. You would have a portion of it that would be deductible. And of that amount, whatever that you made for those rental days, 100 days, let's just say you were getting it for $200, so you got $20,000 or whatever it is. Is that it? I might be a zero off, but whatever the case, you end up with this cash. Now you can offset it with your depreciation and things. But if you end up with a big loss, you just can't use it because it's a residence. That's how the IRS kind of says. It's like if I live in a house and I lose money, I don't get to write it off. If I live in a house and I rent it part of the time and I am over 14 days, over 10%, then they say you get the loss up to the income. And then if I don't live in the house, but I rent it out, then they say, okay, you can have the loss, but it's passive, right? Unless you're a real estate professional, active participant, or it's short-term rental, it's going to be different. So in this particular case, I have no problem with somebody taking a vacation home and making it into a short-term rental. I would isolate that puppy into an LLC. More than likely, I'd probably be looking at whether I want to make it into an S corp. Because I'm probably if I'm doing all the work, then I'm going to have to deal with that because of the type of income that's going to come in. It's trade or business income, and the only question is whether you materially participate in it. I have a couple of options, and based on the facts and circumstances, you'd be able to get narrow it right in. And is that it? Trying to think, there's a few comments, but it's not about this. So anyway, yeah, make it into a short term. Make money. Put your assets to work. Don't worry about all of us, the accountants we're all a little nutty anyway. All right.
And this one kind
Speaking of nutty.
Yep.
The heck did you bring me? I hear a lot about 7 average days, but there's a lot of confusion behind those 7 days. It's literally in a reg and it's spelled out to a T. The only reason there's confusion is because people don't know how to read the regs. Not you, but accountants. They're always like, I never heard about this thing. And I looked in the Internal Revenue Code. It's because it's not in the Internal Revenue Code. It's in the regs that interpret the code. It's still law.
Yep.
But here's how we're treating this stuff. Some say it has to be 7. Some say it doesn't have to. No, it's 7 days or less. It's not rental. So if I have, let's say, 2 bookings of 2 and 12 days, to me, that's still average 7. That's exactly right. And they literally give an example very close to that, right? If I have 4 bookings of 24, 3 and 1 days, that's what, 28 days divided by 4. Yeah, still an average of 7. So anyway, what do you think?
Yeah. So first of all, just kind of pull it back here. Why are we talking about the 7 days? This is because we're talking about a short-term rental as opposed to a long-term rental. And the difference being how they're handled on your return, quite frankly, and where they go on your return. Short-term rental actually has 3 categories. The most common is if the average rental is 7 days or less, and that's obviously what we're talking about here. So we're in the short-term rental universe, okay? So we want to forget all about long-term rentals. The idea and why this is so popular lately is because of bonus depreciation, things like that. It becomes very easy. If your average stay is 7 days or less, that's one of the tests that make it easier for you to maybe take that bonus depreciation as an ordinary loss. There's other things to it, but that's the 7-day test. And you're absolutely correct the way you stated. It's going to, you take the number of stays, take the average like you did with the 2 and the 12, or the 4 different stays there divided by 4. 7 days or less. There is, there's other ones like 30 days or less, but you have to do more work, be more hands-on. There's actually one for over 30 days, which really isn't applicable to most of our clients. That's if you're using that property for something other than really a rental purpose, like maybe a halfway house or something like that, where the actual operation, what you're doing in the home is far more important, integral to what's going on than the actual rental of building. So back to the short-term rental where we're just having someone from Airbnb stay there. That's going to probably be your 7 days or less. That's the most common test. And you've laid it out perfectly here in your example of how it is.
Yeah, there's the 7 days is the easy.
Yep.
Can you still have, and all it is the difference between, is it real estate rental or is it trade or business income? So you guys know me, I like to
Pizza.
We're gonna have a pizza shop. That's a trade or business. We open up the pizza.
Pizza time.
Yep, it's pizza time, and we have the oven and we're making pizzas. That's a trade or business. Real estate, when it's 7 days or less,
Pizza time.
it's now a trade or business. And the only question is, am I materially participating in it, or is it a passive business? But it's no longer rental activity. The IRS says rental activity is passive. And then it says, here's 3 situations when it's not. Situation 1, 7 days or less. Situation 2, less than 30, which requires, I think it's substantial activities performed in conjunction with it. So it's like your halfway house. Number 3 is greater than 30 days and extraordinary services. So like you're at the one I always think about, this is horrible, but I always think of like a fat farm or a recovery, like these 6-month recovery facilities where they're doing alcohol or drug recovery. Just because you're renting somebody 6 months, that's not rental activity. That is business activity, that trade or business activity, because you're paying one price for one big thing, and they're going to say, no. That's not rental. They're there for the health benefit, for example. So those are in the regs. And they're very, very clear. That's why when I said there's confusion, 7 days in average, there's no confusion. 7 days or less is not rental activity. That's a trade or business. There is no argument out there that it's somehow, no, that's all right. No, you're a hotel. You are 7 days or less, you're a hotel. That's what the IRS is saying. Don't let anything else fool you. In fact, you depreciate the house over 39 years now too.
Yeah.
Because they say you're not a investment real estate. You are not, you are an active business. You're a business. It's trade or business income. And the only question is whether you, as one of the owners, are materially participating in that business. And that will tell you whether it's passive or active. And then even if you materially participate, they don't charge you self-employment tax on it unless you provide, what's the term for it?
Not the substantial service.
It's not substantial. It's another term.
Significant.
Significant services
Yeah.
with your rental, which they say is things that a hotel would provide, like concierge, food, and things like that. Then they would say, aha, now we're going to hit you not only with ordinary income tax, but we're also going to hit you with the FICA. So anyway, that's why I say, like, you got to have somebody who understands this, because it is kind of a, if this, then this, if this, then this. And we could tell based off your facts and circumstances pretty quickly what category you're going to fall into. So here it sounds like your short-term rental, 7 days or less, gear for that, make sure you're hitting it, and you're going to be fine. There are ways, even if you're above that, to still be a trader business. And if you don't want to be a trader business, let me just tell you, I don't know if I have a pen. Maybe I do. Here, I'll show you guys the workaround. If you want to treat, like if this is you and you have a short-term rental and it's 7 days or less, but you want your real estate to be treated as long-term, sorry to scribble, then you rent this to an S Corp or an LLC taxed as an S Corp. And this is the host with Airbnb. So there is a workaround if you're like, oh man, I don't want my property to be treated as short-term rental. I'm a real estate professional. I want to keep all of my activities as long-term rental so that I qualify. I don't want to have I don't want to get confused and schizophrenic. Then what you do is you set up your LLC and you rent it long to an S Corp that acts as your host. And you could do that with multiple properties. Fun.
Yeah.
Sorry.
Oh, that's great.
Blah, 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 blah.
Very good.
Blah, blah, blah. I need, what's this one? I don't know if I like that. Sonic rings. I think I'd rather have this one. All right. All right, we can sing along. I realized capital gains. Okay, I can't sing along. I realized capital gains from installment sale in 2023. I've not received capital gains up to my basis yet. I will have a chunk every year up to the next 5 years. Can I still invest in a qualified opportunity zone? Glad you're here to answer that.
Okay, so on an installment sale, you basically have three components. We'll talk more about two of them. You get a return of your basis and a portion of capital gains for each payment that you get. There'll be a calculation where you take the
And your recaptures all in year one.
Yes, very good point there. And so I think what we're asking here is, Ellie, Toby, is there any way that we can push, the capital gains into a qualified opportunity zone? And you can on those payments. And I was looking at this, and the IRS looks at each payment individually.
Separately,
Yeah. So you could, but the bigger problem here is that QOZs are ending very shortly.
Yeah.
So you're really effectively only going to be able to do this for 24 payments and 25 because it ends at the end of 26.
And talk about a pain.
Right?
A major pain, because then you have to hold it for 10 years.
Yeah.
You're not going to get any step ups now because it was 5 and 7 years.
Yeah, the train really left a qualified opportunity zones all the way back the year when it first came in.
So you actually have 3 types of income, by the way, when you're doing doing the installment sale. So you have the recapture, which recognized in the year of the sale. You have the return of capital, you have the capital gain, and then you also have interest. So you actually, this is the joy of those. So you have three types of income every year. Return on capital, which is 0. Capital gains, which depends on your tax bracket, is going to be 0, 15, 20%. There might be the net investment income tax of 3.8 and plus your state. Then you have your interest, which is ordinary tax and plus your state. It could be a bit of a nightmare, right? But you're stretching out that capital gain so that maybe you're in that 0% year after year, maybe you're in that 15%. We've seen that where somebody that would have been hit pretty hard, they would have been out 24%, 23.8%, ended up stretching things out at 0 and 15% as a result. But they also had to recognize a little bit of income, the interest as in their ordinary bracket. So it's all a little bit of math. I always I don't mind installment sales. I use them to close on deals with especially folks that are liquidating their portfolios. They don't have kids they want to leave it to, or interested folks, and they have 20, 30 properties, and they're like, you know what, I just want an income stream. And I get it. And I'll say, all right, we'll stretch it out. How long do you want? 10 years? Okay, great. And they know that way they have income every year coming in, and they don't have to, they don't have to unclog toilets. And they can just go do whatever they want to do. I've done that a few times, more than once. So I get that, but for me, I'm just not it's not huge for me. I'd rather do a 1031 exchange, get all my money now, not pay any tax, as opposed to deferring it and stretching it out. I don't really care. I'd rather make money on my money than wait, but that's me. But qualified opportunity zone, you could do it. It's on receipt, and then you have a new 180 days
Yes.
to put it into a qualified opportunity zone fund that then has 180 days to deploy that money. So you have all these timelines, and literally every month you have a new timeline to keep track of. So you do that for a few years, you got a spreadsheet that's going to make your head hurt.
And
It's
it's not,
doable.
but it's not around much longer. The deferral ends at the end of 26. So
Yeah. So you'd have to be in an opportunity zone. Then you got to own it for 10 years before you get the step up.
yeah,
I just found them to be kind of red herrings. I just did not.
I'm sure somebody's going to make a killing off of it, but I don't think that's the average investor.
You would
I
see
don't know.
people pitching.
Mm.
Here's the reason we're going to do all this great stuff.
Right.
I think the one that really flew under the radar was if you opened up a business and hired half the people in an opportunity zone, then you could avoid the tax on the business.
Yeah.
That's the one that I think there's going to be people that exit businesses for many millions of dollars that are going to be doing all right because they did that. The real estate, they're opportunity zones for a reason, right?
Mm.
They're not the greatest places. It's like, I don't know, trying to get rich doing D-level rentals. You could do it, but it's painful. So I've just seen a lot of pain in those. I would like to focus on 1099 related options. I'm a truck driver and I feel I'm paying very high taxes.
Yeah. So I've seen a lot of clients come in. We have several clients that are truck drivers or have trucking businesses, et cetera. And we run into this kind of question all the time, but this is broader than just driving a truck. This is very much like some of the earlier questions we had where, hey, the 1099, for those of you who don't know, that just means you're an independent contractor. You're not W-2 employee, but they're still paying you. It's just that all the taxes come out on you. And this is where you get to that Schedule C, sole proprietorship that Toby was relating to earlier. Wow, you want to have a chance at an audit, winning that lottery? Well, then go Schedule C. But just for that purpose alone, probably you want to take your money, if you can, receive it in an S corporation is most often where we'll go. It could be a C, but maybe an S corporation. That's going to allow you to save on employment taxes, much like we discussed prior, because now maybe only a third of the income you receive you have to pay as a wage, subject to employment tax. The rest is called a distribution. You're still going to pay income tax, but you don't have that extra employment tax on it. And because it's a corporation, again, an S corporation, you can do all the reimbursements, such as the home office. You can do administrative office. That's what I was thinking about, mileage, things like that. And then also, of course, the corporate meetings under 280A. If you have maybe some medical, or your family has a lot of out-of-pocket medicals, then maybe the C corporation, because that has a medical reimbursement plan.
And don't ever miss out when you have active income, and especially if you feel like you're getting pinched, look at those retirement plans. Look at a 401k, and for some of you guys, the defined benefit plans. if you look on the YouTube, there's a video I just did. Jeff Mason, not that long ago. He's an actuary. We have a client that put $1.2 million a year away last year in their retirement plan, tax deductible. So it all depends on your age, if there's other employees, the actuarial assumption that he's allowed to make. There's a video, I think it's the $100,000 plus retirement plan. It was like 2 weeks ago. You go look it up. But that's two actuaries sitting there going over, here's the numbers that we do. Patty put the link up. Really interesting stuff. Like it's a little bit brain numbing. Like you're like, oh my God, they're talking a lot of numbers, but they spell it out so you understand. The only difference is like typically when we do like a 401k, it says, hey, Elliot, you could put $23,000. Are you over 50?
Yeah.
Oh, so you can put 30,500 or something like
I
that.
got the old timer rate.
Yeah. So, but it says, here's how much you could put in. This says, how much are you making? And based off of that, how much do we need to have put in your retirement plan so you keep making that when you retire? And it ends up being a lot of money for a lot of people. You're making 200 grand a year, 300 grand a year, and you're like, man, I need to have 3.5 million put away so that I can keep paying myself that when I retire. Okay. And you could put away 100% of your income. This is how crazy that stuff is, but that's how it works. It's called cash balance plan, defined benefit plan. If that's you, have somebody run your numbers. Like I'm always shocked at people who said, well, my accountant said it wouldn't help me. Well, what were your numbers? Whoa, we never talked to an actuary. It's like 3 rules of tax. Calculate, calculate, calculate. I used to hammer that home all the time, but you just get someone to run the numbers that's competent. Don't listen to some accountant, put their subjective belief. Don't listen to me. For example, if I look at it, Elliot and I would say, that might help you. Let's run the numbers. When I see cost seg, hey, let's run the numbers. You'll always hear me say that. Hey, let's go over to Cost Seg Authority and Eric Oliver and those guys and have them run your numbers. And then they come back to me. Here's what the numbers look like. Okay. Hey, do you think this is worth it? It's going to return. Oh, it's going to cost you $1, but it's going to save you 10. Okay. So that $9 that I get to keep now, instead of waiting 30 years or 27.5 years or 25 years. Yeah. There's a time value of money. You can make a determination based off of that and say, yeah, it makes sense to do that. Or no, it doesn't make sense, but you can't. I don't want to guess. Get the calculation done. And so when you're looking at these types of scenarios, I got a 1099. What I would do is I would say, all right, if I treat you as a sole proprietor, here's what you're at. If I treat you as an S Corp, here's where you're at. If I keep you as a C Corp, here's where you're at. If we add in a 401k, let's if we do this over here, here's where you're at. And then we can, hey, is it worth it to make a change based off of these numbers? The old adage is, is the juice worth the squeeze? And if it is, fantastic, make that change. If it isn't, then don't. But I don't want anybody to guess.
Except if it's the third question we had about the spouse putting their business underneath that S corporation.
Yeah, just don't do that.
Money's not an issue there. It's keep them separate.
That's asset protection.
Yeah, that's
otherwise the tax.
yeah.
Fair enough. All right. Hey, there's Mr. Coons. Let's see, right there. Look at that. Tax and asset protection. So if you want to learn all this stuff, by all means, join us. There's some links to do it. All right. Sold our investment property in 2023, which was previously our residence for 10 years. I wonder how long they actually owned it, because this makes my head hurt. I'm trying to figure out. When we started renting out our property about 5 years ago, our CPA did not advise us on updating the cost basis, because you don't. Right. We have done many upgrades to the house during the 10-year stay. So this year, when we file our taxes and report the sale, we will be using the initial cost basis for the home. My question is there any way to deduct the expenses we had when it was our residence?
Yeah. So anything you put into the property, which we call improvements, you added on to it, you remodeled, what have you, those are all supposed to go to basis. And yeah, your CPA was incorrect. When you started renting, it was supposed to be, catch up that basis. So really what we have here is we didn't take proper depreciation for that 5 years that we were renting. We do have a tool for that. It's called Form 3115, and we can catch up that missed depreciation,
Mhm.
and that's gonna cause us to capture that basis that was missed before.
You don't lose it until you start filing and then go beyond yours. So like you could still get it.
Yep.
The part that frustrates me is they should have told you when you moved out of the house that you'd been living in to sell it to another entity. Because the rule is your basis or the fair market value, whichever's less. So even if the accountant had said, hey, we have this issue, the fair market value might have skyrocketed, but they're like, it's not going to increase your basis. We could have increased your basis tax-free by selling it to an S corp and capturing the 121 exclusion. I feel like we probably left a lot of money on the
Yes,
table.
there's no question about that.
So if you lived in it for 5 years and then rented it for 5 years, I would have really have liked to seen what the value of that property was when they did it, because we could have sold it and then you would have had even more depreciation over the next 5 years. You would have had a much higher basis. You would have paid a lot less tax now. And you would have enjoyed some significant tax savings.
Yeah, and being an S corporation would be able to do some fund deductions and
Somebody says,
reimbursements.
what's the 121 exclusion? So the 121 exclusion, where did it just go? Oh, weird. It was just there, now it's gone. The 121 exclusion is when you have a sale of personal residence that you lived in as your primary residence for 2 of the last 5 years. Then the capital gains up to $250,000 if you're single, or up to $500,000 if you're married filing jointly, are excluded from tax. So they call it an exclusion. So the 121 exclusion just means, hey, if I lived in a house, let's say I bought a house for $300,000 and I lived in it for a few years and made it into a rental and then sold it a year later. Whatever that capital gain is, let's just say I bought it for 300 and sold it for 500. I wouldn't have to pay any tax on that. The capital gain. If there's a little bit of depreciation recapture because I depreciated it for 1 year, then I'd have to pay ordinary tax on that up to 25%. But the capital gain would have been excluded entirely. So when I see this situation, if they were living in it for 5 years, and you can only do it once every 2 years on a primary residence. So they lived in it for 5 years. They had 3 years to sell it to another entity or to another third party and capture that 121 exclusion. And that's the part that makes me sad, is we missed it. If we had known them back then, they would have been dripped on constantly, probably by us going, hold on for a second. What is it worth? What is it worth? What is it worth? And, just for sake of understanding, the average amount of a house has grown in the last 5 years was 47%, I believe. Like there's a lot of gain that would have been great. Let's lock it in.
Yep.
Let's lock it in. You do a self sale, you do an installment sale, you elect out of the installment sale for tax purposes. So you recognize all that capital gain, which is excluded from tax. So you don't pay tax on it. But now you have a house and you're depreciating at its much higher value, which gives you more depreciation, and you never pay tax on that gain again.
And
I
a
hope
couple of
that-
them just asking about why the S corp and not an LLC.
It has to be a separate taxpayer.
Yeah, and it can be an LLC tax as an S corp.
Yep.
Okay, so no problem there.
It just has to be somebody that has a different tax return other than yours. Because if it was on your return, then it would just nix it out. It would just it would wash. But the IRS is already it's already ruled on this. If you sell it to an S corp, it's considered a separate taxpayer, and as long as it's fair market value, so you get an appraisal done, then you're okay. And again, the way that I do it is I would sell it on an installment sale to the S corp, and the S corp's going to pay you over time. So as it collects rents, it's going to pay you. But you're going to elect out of that for tax purposes. We're not going to spread out our gain and have interest. We're just going to say, boom, we're recognizing it this year. Boom, we have $200,000 a gain. Ha ha ha, because it's excluded. You don't have to pay tax on it. So you're like, I want to recognize it this year.
Yeah, it's great,
Yeah,
great play.
I'll take that action. All right, more fun. I heard you don't want to put real estate in S corp. Typically,
Except for this.
yeah, this is one of the few times you do, because the reason that people don't is because to take a property out of an S corp, then you have a taxable situation when you go to refi it. So if you do this with your own home and you're selling it to your own S corp, you're buying it's got to be cash. And we don't care because the house value is really, really high. So even if you take it out, let's say I sold it and then I took it out to refi it, that's not taxable. If I'd had it in an S corp and I'd taken it out to refi after it appreciated, then I wouldn't have tax, right? So, and then if you die, the basis of the S corp steps up, which means you can liquidate the real estate, transfer it out to the shareholder, and it's non-taxable because you have the step up. There's people that think you lose the step up too, but again, they just don't understand how the taxes work. They're just they're myopic. Well, the real estate doesn't step up. It's because you don't own it. The S corp owns it, but you own the S corp, so the S corp basis steps up. Sounds too complicated. It's actually pretty simple when you know what you're doing. That's why you have people who know what they're doing. Can you change S corp to a partnership later on? I think you'd have a deemed sale at that
It'll be a
point.
distribution. You have
Yeah.
a dissolution of the S corp at that point.
Yeah, I mean you could, but I
You
wouldn't.
can,
And
but I wouldn't do it.
the S corp, everything keeps its nature. So if I sell that property for capital gain later, it stays as capital gain, just flows through the S corp. It's still a flow through entity. It's just if you take it out to refi it, that's a taxable event. So so we don't do it generally. You're going to use a LLC, taxed as a partnership or disregarded. Fun stuff. I see different ads from others saying there are options other than a 1031 exchange to defer taxes. Looking for any viable options, please.
So this is one, I know this one because Toby actually had me cut a video with him on this where we talked about a lot of different options. And I don't know if Patty can get that link, but it was the how to avoid taxes when selling your rental property. How about that for a title? So if we hit that one, whenever you sell a rental property, we're looking for your capital gains. How do we defer taxes other than a 1031? We can look for REITs. We can look for
You're doing an UPREIT.
yes, excuse me, UPREIT, yep. Umbrella, partnership, real estate investment trust, things like that. So the video, we go through a whole lot, 20 minutes of this, so we won't probably recap all that right now. But that would be one option, certainly. And then there's the Delaware Statutory Trust as well.
That's a 1031 exchange into a Delaware statutory trust. You could do a Delaware statutory trust to a REIT, which is a 721 exchange. You have the qualified opportunity zones. You have installment sale for stretching it out.
Yep.
You have the lazy man's 1031 where you're buying an additional property, creating a passive loss, but that passive loss can offset passive capital gains on the sale. So there was a whole bunch. What's the title? Patty wants to know.
How to avoid taxes when selling your rental property.
That's a very creative title.
I know when we were looking at that, me and one of my colleagues, and we noticed that, 100,000 views for this Toby video, 200,000 for this one, and then one with Elliot was like a measly $4,000 or something like that.
That's good. Hey, don't be hating on it. They don't all go great. Sometimes they.
Well, we saw that there's only one thing that was different amongst the three.
But no, the average isn't all that great. There's almost 900 videos up there. They don't all go well. But they're not supposed to.
They don't go viral. Huh?
That's a very that's somebody selling their property. Like they'll see that when they actually, hey, how do I avoid capital gains? Like this person.
But it's great. Toby breaks down all of those things he just listed: installment sale, the DST, the whatnot. So it covers a lot of. It's really on point with this.
You want to avoid tax? Just donate the damn thing.
Yeah.
Then sell it. Then people go, you can't do that. Yes, you can. You could take a deduction. I could donate it to my own public charity or to my own donor advised fund if I really felt like it. Probably be better to do your own charity. Donate it, take the deduction at its fair market value, and then let all the gain be in that charity, and then do something good with it. You could even run it. It doesn't matter. It's like, wait a second, I didn't pay any tax.
Let's call Kareem up.
Oh yeah,
See if he's still
it gets
listening.
better because you got a tax deduction.
Yeah.
But I already wrote it off once. Yep, you write it off again. Yeah, let's do it twice. If writing it off was awesome the first time, imagine how great it is the second time.
Yeah.
Right. So you could do that. And yes, you can. I could hear somebody thinking, no, you can't. And
No, we're
yeah,
shutting
yes,
that
you
down.
can. Yep. Yeah, you can. And people do it all the time. And our clients do it all the time. There's lots of options. It just depends on your scenario. All right. Being a senior over 70. So they took a long time before they went to school.
Mhm.
Get
Yep.
it? Get it?
Yes, I get it.
Wait, 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 wait. Damn. Nope, that's not it.
Yep, yeah, that's it.
That sucked. All right. Being a senior over 70, I really enjoy all the videos I watch on YouTube, as it's never too late to learn and try to understand real estate investing and taxes. But even if I do pick up some of the things, I still would need experts to do the job for me. No, you wouldn't. What would it cost for Anderson's group to follow my future investments? I want to do this for my daughter, who is now in her second year of college.
Yeah, so we have a lot of things out there. As Toby alluded to at the very beginning, when we first went through this question, we're not investment, planners or anything like that. What is it, the certified financial?
There's CFPs, there's all sorts of folks. We could send you over there, but for
Yeah.
real estate, you're just learning to do it yourself. If you want turnkey real estate, come to Infinity Investing. We have over 4,000 properties under management where you go through our partner Alpine Capital. We find you single family homes in areas where we actively manage it. So you don't have to do anything other than collect checks. That's pretty easy, but we don't want just passive investors. We want you to understand why we're doing what we're doing and bring your daughter along and have her learn it. I have a daughter too, and I'm always trying to drag her into real estate, and she owns pieces on her own now, and she hates me for doing it some days and loves me for doing it other days, right? Real estate investing, I keep saying, hey, 10 years, you're going to be so happy. There are days where you have tenants where they're being annoying and things like that, but that's why you have managers. You're not fixing any toilets. You don't even need to go see the properties, but give it time. It's like anything. Give it time. It'll cook and it'll be great. Just let it simmer for long enough. So you're looking at it going, hey, I'm 70 years old. Do I have time? You absolutely do.
Yes.
And then I want to plant the seed that you're looking at 200-year stretches. When you start creating a plan, don't think of it in terms of 10 years or 20 years. Think of it in terms of 100 years, 200 years, 300 years. If you create something, don't just create it for today, create it for a long term. And when you start thinking that far out, it changes your trajectory a little bit. And you'll be shocked at how easy it is to put something together. And then, 30 years goes by so quick. And you'll be like, whoa, this thing's taken care of. Unfortunately, just today, I had somebody is horrible. Ended up with a cancer diagnosis, stage 4. And the one thing she said was, thankfully, I'm in real estate where I'm able to go do the things I need to do. She's able to go get treatment and do things. It's not looking good. She lost her husband, 2 years ago? And it's a bad situation, but at least she's not sitting here going, I don't know how I'm going to work. I don't know how I'm going to eat. I don't know how I'm going to do both. She said, thank God. That's what she said, because she had those assets. And I always think of stuff like that. I'm like, what happens when Infinity Investing, by the way, the whole premise is when you have rents, royalties, dividends, interest, and short-term capital gains from options, when you have those 5 types of income sources paying for your expenses, you never have to work again. Now you're at infinity. You can live an infinite number of days without having to work. Otherwise, if you lost your job tomorrow, or if you were no longer able to work, how long would you survive based off the assets you have? If it's a number that you can calculate, anything other than, hey, I have so much money coming in, it covers my costs, then you're not at infinity. So it's a lot of people, it's 40 days, it's 200 days, it's 2,000 days. Hey, I'm going to last 8 or 9 years. That's not where we want to be. We want to be at it where we could live an infinite number of days from our passive income sources, from our rents, royalties, dividends, interest, short-term capital gains. You get there, you're fine like wine.
And I just thought, I love this question just because, yeah, you're never too old. Just keep learning. My dad still learned, I don't know, he learned how to cement bricks out of nowhere when he was like in his 60s, so he could build a mailbox. And it was the most solid one in town.
That's probably a lot harder than real estate.
Yeah.
Oh, the rules of real estate investing, it's easier. All right. YouTube, feel free to join. We're not going to hit you over the head with it too many more times. There's Clint's. you should go join his. He's a great teacher. The tax and asset protection workshop, please attend. And by the way, if you guys want a strategy session or something, you want to talk to anybody, just immediately just reach out to Patty or somebody and say, hey, I would love to discuss, or I'd like a strategy session, and we'll hook you up with somebody to go over your situation. In the meantime, we're 2 weeks before we do another one. You can always email in your question. This is where we get the questions that we read. Tax Tuesday at AndersonAdvisors.com. Elliot fields hundreds of them and weeds out and picks 10-ish.
Yep.
Right? We answer your questions no matter what, but we like to pick about 10 to go over the various themes. He picks them. I just answer them.
Yep.
All right. So let's see, there's 3 questions waiting to be answered. Thank you, by the way, to Troy,
Huge.
Tanya, Rachel, Jeff, Jared, Dutch, Arash, Patty, Matthew. Thank you guys for answering all those questions. They always answer. There's 160 questions they've answered.
Crazy.
Yeah, there are 4 left. So what I'm going to do is say adieu, but we're going to leave the event on until those 4 questions are answered so that you guys all get it answered. And as soon as those are done, then we're done. So I just want to say thanks for joining us, and I'll see you in 2 weeks.